Kwon has been sentenced to 15 years in federal prison after the TerraUSD and Luna collapse that erased more than $40 billion in value. This is a major moment for crypto regulation, stablecoin design, and market trust. Prosecutors say Kwon misled investors about how UST would hold its $1 peg. When the peg started slipping, he claimed the Terra protocol would automatically restore the price. But court filings say a high-frequency trading firm was paid to buy large amounts of UST, creating the appearance of stability while demand was fading. Here is the core problem. UST was not backed like USDC, and it was not over-collateralized like many DeFi stablecoins. It relied on an algorithm and a burn mint swap with Luna. If UST traded below $1, the system destroyed UST and issued more Luna, hoping arbitrage would push UST back up. That only works when confidence is high and liquidity is deep. Anchor made the risk bigger. Early on, it advertised roughly 20% annual yield for depositing UST. Those payouts depended on incentives and fresh capital, not durable cash flow. At its peak, about 70% of all UST sat in Anchor. When yields dropped and large holders began withdrawing, the algorithm printed huge amounts of Luna. Luna crashed, UST broke further, and the system entered a death spiral. The Department of Justice brought 9 criminal counts tied to wire fraud and related conspiracies, including securities and commodities fraud and money laundering. The judge said the harm was extraordinary, and the sentence places Kwon alongside other high-profile crypto fraud convictions. For markets, the takeaway is simple. A stablecoin peg is only as strong as its reserves, its transparency, and its incentives under stress. Expect more scrutiny on algorithmic stablecoins, marketing claims, and yield products that look too smooth in volatile conditions. Subscribe to BlockBrief for daily crypto news and market updates, and as always, do your own research. Kwon's case shows how fast a stablecoin story can become systemic risk. In early 2022, UST was marketed as a decentralized dollar. The promise was that incentives and code could replace reserves. But once large redemptions hit, reflexive mechanics took over. Selling pushed UST down, minting pushed Luna supply up, and the feedback loop accelerated. Investigators focused on the gap between public claims and private actions. If a project says an automated defense will restore the peg but relies on quiet support trades, that is a serious disclosure problem. When that support stops, the unwind can be violent. The sentencing follows a long legal path. Kwon was arrested abroad, extradited to the United States, and later pleaded guilty. Officials say the damage reached tens of billions of dollars, rivaling the biggest failures of the last cycle. What to watch next? Stablecoin rules are moving toward tighter standards on reserves, audits, and marketing. Exchanges may also apply stricter listing policies for algorithmic designs, and traders will watch for volatility in Terra-related tokens whenever new court documents or payouts are discussed. If you use stablecoins, ask 3 questions. What backs the token? Who verifies it? And what happens when liquidity dries up? High yields must come from real revenue, not endless token emissions. Keep position sizes modest, spread custody, and avoid treating any peg as guaranteed in stress ever.